A bank reconciliation balances in 2 minutes and nobody questions it. That is exactly when you should worry. In this episode, we go beyond the mechanics and look at what a reconciliation is actually controlling for, where the real risk sits, and how to build one that would survive audit scrutiny. The core problem is simple. You have two independent records of the same cash account, your cash book and the bank statement, and they almost never agree at month end. That disagreement is not an error in itself. It is the normal result of timing differences and information gaps between you and your bank. The reconciliation's job is to explain every single cent of the gap. Reconciling items fall into two categories, and you must never mix them up. Timing differences are legitimate. The transaction is real and correctly recorded by one party, but the other party has not processed it yet. Errors and omissions are a different matter entirely. One party has recorded something incorrectly or not at all, and a correcting journal or bank query is required. Failing to distinguish between these two categories is the most common mistake we see in practice. Let us walk through a complete worked example. At 31st March, the cash book shows a closing balance of 214,000 Rand. The bank statement shows 241,500 Rand. There is a difference of 27,500 Rand, and we need to explain it fully. Starting with the bank statement balance, we work downward to arrive at an adjusted figure. Deposits in transit of 18,000 Rand appear in the cash book, but have not yet cleared the bank, so we add them. Unpresented checks totaling 31,000 Rand have been issued and recorded in our cash book, but have not yet been presented to the bank, so we deduct them. The adjusted bank balance is now 228,500 Rand. Now we adjust the cash book side. The bank charged monthly service fees of 800 Rand and debited a dishonoured cheque of 4,000 Rand. Neither of these appears in our cash book yet, so we deduct them. We also discover a direct deposit of 15,300 Rand from a debtor that was not captured. Adding that in, the adjusted cash book balance also lands at 228,500 Rand. The reconciliation balances, and we know exactly why. The cash book adjustments must be journalized before the financial statements are finalized. The direct deposit is a debit to bank and a credit to trade receivables. Bank charges are an expense. Debit bank charges, credit bank. The dishonoured cheque reverses the original receipt. Debit trade receivables, credit bank. Each entry is straightforward, but all three must be posted before close. A bar chart of the monthly unreconciled differences over 6 months tells you more about control quality than any single reconciliation ever will. A widening gap or a volatile pattern signals either growing timing differences, which could mean checks are going stale, or accumulating errors. Auditors and internal reviewers look at this trend first. Stale checks are a specific risk that practitioners often overlook. A check that has been outstanding for longer than the bank's validity period, typically 6 months, will never clear. It sits permanently in the unpresented column and inflates your adjusted bank balance. The correct treatment is to reverse the original payment journal, debit bank, credit the original expense or payable. If the underlying obligation still exists, you then re-raise the creditor. Leaving stale checks in the reconciliation indefinitely is not acceptable and will attract an audit finding. Now the fraud angle. A reconciliation that always balances neatly is a red flag, not a green one. Compensating errors, where a deliberate understatement in one line is offset by an overstatement in another, can be designed to produce a clean total. Teaming and lading, where a cash receipt from one debtor is used to cover a misappropriation from another, will cycle through the deposits in transit column before eventually clearing. The control breaks down when the same person prepares the cash book, reconciles it, and authorizes adjustments. Segregation of duties is the primary mitigant. From an IFRS perspective, IAS 7 requires cash and cash equivalents to be presented separately on the statement of financial position. Where a bank account is in overdraft, it is reclassified to current liabilities unless a legally enforceable right of set-off exists against another account at the same bank. The reconciled adjusted balance, not the raw cash book balance, is the figure that feeds the IAS 7 disclosures and the statement of cash flows, opening and closing balances. To make a reconciliation audit-ready, document the reviewer's name, the date of preparation, and the date of review as separate sign-offs. Every reconciling item in the timing column must have an expected clearance date. Any item older than 30 days in that column should be escalated, not carried forward silently. Keep the supporting evidence, being the bank statement and the cash book listing, attached to the reconciliation itself. A reconciliation without evidence is just a spreadsheet with numbers. Bank reconciliation is the first line of defense over the most liquid and most fraud-prone asset on the balance sheet. Done properly, it is a genuine control. Done carelessly or by the wrong person without review, it is theater. The mechanics take minutes to learn. The judgment about what the reconciliation is actually telling you is what separates a junior bookkeeper from a qualified CA.